There's really nothing new under the sun, and that's because human nature doesn't change. The characters change, the names change, but it's fear and greed. We can go back to the South Sea bubble, Dutch tulip bulb mania. History repeats itself over and over again.
Put AI into that context here, because people have been positioning AI. Other than electricity, there's been nothing more important than AI. How do you think about just this whole concept writ large?
I'm not bearish on AI per se. I'm sure we're all going to use it. Many of us are using it already. The question is, what's the ROI on the AI? It starts out, the way these bubbles all start, there's a kernel of truth that captures the imagination of the individual, whether it's the South Sea bubble, or it's Dutch tulip bulbs, or it's .com, which I've lived through.
Yep.
And it starts out as a good idea, but what happens is the price changes immeasurably. And the best definition, I've actually heard of a bubble. There are many definitions. The best one I've heard is something that changes human behavior, that people do things that they wouldn't do otherwise, whether it's because of FOMO, fear of missing out, or otherwise. And I think that's kind of where we are with AI. I mean, I'm happy to change my mind, but show me the money. Where's the ROI? And I don't see it. And I don't see it coming either.
It doesn't seem to be deterring capital from flowing to that business. We've seen extraordinary amounts of equity raised. Now we're seeing tech companies that never even thought about the bond market raising tens of billions of dollars in the investment grade bond market. We've got a Korean company listing its ADRs today here in the U.S. I mean, I've been on global Wall Street for 30 years. I've never seen this amount of money flow.
The things I read the same sources you do. I file that under my category on X of things you don't see at the bottom. We've seen this movie before with Japanese subtitles, housing subtitles, tech subtitles. Go back to .com. I actually think this is much worse than .com, simply because the sums involved are that much greater.
This is really important because, the fossils sitting around the table, we talked about Will Danoff a couple of days ago. I remember being in meetings at 60 State Street, .com and all that. What's the distinction right now versus 98, 99, and then what we enjoyed in 01?
Again, I want to elaborate on the sheer magnitude of this. Julian Garrett of Macro Strategy Partners in the UK, erudite economist I've known many years, has made a calculation that this bubble, this malinvestment is 17 times what we saw in the era of .com. And what's allied to that, what's really important is the sums involved are so much larger relative to the real economy. The fallout from this could really be much more significant. For
Global Wall Street on this Friday, a real treat. George Noble with us, of course, definitive at Fidelity with Mr. Lynch a few years ago at his Noble Capital Advisors. He's been on fire out on LinkedIn and Twitter with his criticism of the moment at hand. Paul Sweeney with George Noble.
Again, another definitive part in this market was the IPO of a company called SpaceX.
Oh my! Thought you'd never ask.
What do you make of that? I mean, I can't imagine sitting in a Fidelity office conference room and, the bankers bring Elon Musk in to make this pitch. I would have loved to have been a fly on the wall. What do you make of that?
History shows that buying companies at over 10 times revenues usually ends very badly. We all recall Scott McNealy famously in some microsystems. What happens? What your return is going to be if you buy something 10x. This is 120 times revenues, and it's even if you look at the company's projection. I mean, they're already borrowing money. You look at the company's projection; they'll be cash flow negative for years to come. And here's the worst part of SpaceX, which I don't want to engage in the Captain Obvious thinking, but the thing everyone should consider, and that is the staggered lockup the unlock that we're looking at. Okay, starting from next month when the quarterly earnings come out, 20% of the shares come unlocked shortly thereafter, and then there's a whole series of unlocks, 7% every 20 or 30 days. By December, 100% of the shares will be freely floating. The important point that investors should understand is even without any change in the fundamentals, when you go from a 5% float to 100% float.
George, in the old days, when you would take a 2-hour lunch at Lockober's and you used to hold court there off the bar, but in the old days, when a company went public, it took its shares public and maybe they had a little stub they kept private. Now we're unloading 5% of the public. To me, it's manipulative. Should regulators step in and get the initial public offering market back to a normal segmentation?
100%. It's not a question of what's legal or illegal. It's just not right. Society is not well served by allowing this. grandma's 401k is the exit liquidity for this manipulation. And I think the regulators are asleep at the wheel. They only usually jump into action after the car crash has occurred.
Gensler has sat in this chair recently, and I said to Gary Gensler, I said, okay, you let Bitcoin in, I get it, it's a free market and all that. But what do you say to retail that enjoyed BitDog at 110 and it's now down at 60? SpaceX, okay, it's back to 150. I'm watching the debt of SpaceX. To be blunt, it can't find a bid.
And allied to that, Tom, I promise you that once it goes under the offering price and the unlocked shares come to market, the insiders who are in it at 1/10 of the current price, they're going to hit the bid so fast it's going to make your head
Well, I got to
spin.
make some news here. To be honest, Fidelity was way out front with
Correct.
Mr. Musk on this. Would you recommend that Abby Johnson and the team sell their SpaceX?
They know the company better than I do. Let's just say if I was handed a portfolio, if Philly were to rehire me, I would sell it right away.
Elon Musk, you have to. I'm not sure we've seen anything like this in terms of the value that gets ascribed to Mr. Musk relative to the earnings, relative to the cash flow. We've seen it for years in Tesla. And you look at the Tesla analysts, the auto analysts all have holds or sells on it and they've been wrong. And the tech analysts have all been saying, just buy it. It's Elon. It's autonomous robots and all that kind of stuff. Have you seen that in the past where one individual can have such an influence on valuation?
No, I think Tesla is probably the biggest misallocation of capital at scale in the history of stock markets, perhaps only surpassed by SpaceX. I was one of those wrong analysts. I'm a fossil. I happen to be the auto analyst for Peter Lynch in 1981. We went to Detroit to visit Chrysler, Ford, and GM, so I know of what I speak. Yep. Fundamental work has not guided one in the case of Tesla. I think, however, though, he's bitten off more than he can chew now. Everyone's speculating whether or not SpaceX may merge, take over Tesla. I have no special insight on that. But if I had to gamble, if I had to speculate, not that I ever speculate, I would say it's a reasonable speculation.
Let me reintroduce here, worldwide, including overseas and across America, George Noble with us for years, definitive in the business of overseas investment at Fidelity. Thrilled he's in our studio today. Controversial, to say the least, on the euphoria at hand. Paul Sweeney.
So, George, where do you see opportunity these days? I'm sure you look at various markets, various geographies. Where do you see value these days?
Well, it's a market of stocks. As Peter Lynch always used to say, don't try to call the market. I think there are outstanding opportunities right now in energy. I'm actually quite concerned about the energy picture. I think we're sleepwalking into the biggest energy dislocation in history. You look at the disparity between the divergence between the financial market for oil and the physical market for oil. We're between a rock and a hard place. The energy stocks, crude has sold off significantly the last few weeks, as have the energy stocks. I think the risk reward is very appealing. There's very little downside and potentially a lot of upside. I like reflation generally speaking. Gold stocks, I think, are a huge buy right here. SSRM as an example. 7 times earnings, not cash flow, 7 times earnings, all right? So gold stocks, energy stocks, other commodity names like some of the copper names, they're all very interesting to me.
Part of this AI story, to the extent people are looking for other ways to buy it other than the chips, has been some of the picks and shovels. One of them has been energy.
Yes.
How are we going to power all these data centers that are being built in everybody's backyard? I mean, are they going to stick little nuclear reactors next to each one? How are we going to do that?
He took thermodynamics, CEO.
Exactly.
Well, the one thing you shouldn't do is buy Oklo, which is one of the biggest frauds out there on the market right now. But that's a whole other story. OKLO. We've been short that for a year. The problem with it was some of the names you mentioned, some of the utility stocks. If the AI trade comes unstuck, and I believe it will, I think a lot of those derivative plays are going to take on water. Crude's a little different, it's on a slightly different orbit. But a lot of the derivative power plays, I think, are going to have a big problem. One last joke, it was a great line someone used a few weeks ago on me. They talk about, you got to buy the picks and shovels. I said, yeah, but what happens if you buy the picks and shovels and there's no gold in them hills?
George, I got to get 2 things in here that I think our audience is really interested in. On overseas, in the huge ups and some of the challenges you had at Teton as well, are you correlated on overseas to what the dollar does? Like, do you have to have a weak dollar to make overseas work?
No, you don't. But it's a very good question. You don't need a weaker dollar. What you need to keep in mind is that economic cycles across different geographies varies enormously, and that's what you're trying to anticipate. You need to have somewhat of a top-down perspective, not just bottom-up when you're investing internationally. However, one thing I will say, the dirty secret they don't tell you anymore, way back when I was a young and in the early 80s at Fidelity, there was much less correlation between the markets. Now, given the increasing interlinkages between markets, the correlation is much higher. I like to joke, why do I need to be up at 10 o'clock at night trading the Japanese market, or get up at 5 a.m. to watch the London market? I can lose money just as well between 9:30 a.m. and 4 p.m. Eastern time, and I can get
I hold the high ground on that. And of course, on private credit, I know you've been in the dump known as the St. Regis. The old St. Regis in Beijing was an absolute dump, folks. I'm sitting there in the 90s listening to CDO squared stuff and Banker's Kitty and the whole thing. Are we doing the redux there on private credit and private equity where there's some shadows, to say the least?
You couldn't have said it better. My father always used to like to say there's two ways of learning things, either by precept or by experience. It's much more economical to do it by precept. We're all human. We all think this is brand new. It's deja vu all over again, as Yogi would say.